Hi, I'm Jimmy. In this video, we're looking at how we can use put options to protect our portfolio, or how we can use put options to generate a stream of income for ourselves, a lot like dividends would be. The goal here is to understand what put options are and ultimately how we can use them, what the risk is, and what the potential gain is. Okay, so to walk through put options, we once again have our two investors. Jimmy, who's afraid that people will forget his name and he keeps saying, "Hi, I'm Jimmy," and the much more confident Emily. Both have a decent knowledge of investing, which is a good thing because options investing shouldn't be taken too lightly. So Jimmy is interested in buying the put option, and Emily is going to be the seller of the put option. Now, in real life, these two investors would never actually meet. We're never going to know who's on the other side of our trade. Both simply place trades with their brokerage company, and then they move on from there. Who's on the other side is somewhat irrelevant. I'm just laying these two stories out side by side so we can get an idea of why they might place their trades, and that way we can see what each investor is risking and what they stand to gain. Now, just like our call options video, we're going to focus on Verizon stock, except this time, Jimmy is the owner of 100 shares of Verizon stock. Now, him owning 100 shares is no coincidence because one option represents 100 shares. So Jimmy bought the 100 shares so he could deliberately trade options around that position. Now, that's important for us to remember. One option represents 100 shares. It doesn't matter what the stock is. In our example, it's Verizon, but it could be any stock that has options trading on. But either way, it's always going to be 100 shares. Okay, so Jimmy wants to buy a put option. What does this mean? Well, for me, it's easy to understand what a put option is if we understand what a call option is, or at least how the two of them are related. So if Jimmy buys a call option, well, he's buying the option to buy 100 shares of stock, whatever stock that particular option is tied to. Well, he can buy 100 shares of that stock at a predetermined price by a predetermined date. They call the predetermined price the strike price. The predetermined date is the expiration date. A put option, on the other hand, well, Jimmy has the option to sell 100 shares of Verizon stock at the strike price as long as he does it on or before the expiration date. So we might ask, well, what price can he sell his shares at? And we know that's known as the strike price. What is the strike price going to be? Who determines that? And who determines the expiration date, or the date all of this has to be done by? And the answer is Jimmy gets to choose from whatever the available options are for that particular stock. Let's look at a real life example. This is a quote from Verizon's options chain. This is what that looks like. And in this particular example, this one has an expiration date of April 17th of 2020, which means that Jimmy has to decide what he's going to do with the options at a date no later than the close of business on April 17th. Okay, simple enough. Now, when I pulled down this put option quote, it was January 21st of 2020. So April 17th was 87 days away from that particular quote. And I just want to point that out because the more time you have, the more expensive options will be. So for this particular one, Verizon stock, for this particular quote, Verizon stock at that time was trading at $60.31. And this is very important because options are a derivative, which means that the option value is directly tied to the value of the underlying, or it derives its own value from the value of the underlying stock. In this case, the underlying is Verizon's stock price. So it's important that we know what Verizon's stock price is worth when we're looking at an option. But going back to Jimmy's choices once again, maybe 87 days for him is too soon. So he wants to pull down another quote. In this case, he pulls down June of 2020. Now, the expiration date for this particular option is June 19th. And by the way, monthly options, which is most options that we look at, well, monthly options, they expire on the third Friday of each month. That would explain why put options like this one expire on the 19th of June, or when we looked at the April, it was the 17th. In both those cases, to the third Friday of the month. Okay, so Jimmy owns his 100 shares of Verizon stock, and he's looking to buy a put option. Why would he want to buy a put option? Well, we know that Verizon stock is currently trading at slightly more than $60 per share. And maybe Jimmy bought his 100 shares of Verizon stock, let's say 2 years ago, and let's imagine that he paid about $50 per share for these 100 shares. So right now he's up about $10 per share. Well, now the stock is at $60 per share, and Jimmy's looking to sell his stock in the next 6 months. Maybe he thinks the stock is really worth $70 per share. So what can he do? Well, he can lock in his sell price right now if he wants, for a fee, of course. They call that fee a premium. But let's imagine that he decides he's going to do this. So where does he want to sell his stock at? Does he want the option to sell his shares for $55 a share? Well, if so, that's the option he's looking at. By the way, each of these lines are different options. They often list them all together in what they call an options chain. They list them all together so you can see them, compare price. You can jump from one quote to another easy enough. But just so we all know, every one of these lines represents a different option. So if Jimmy wants the option to sell his shares for $55 a share, he's going to pay $78. That's his fee. They call that a premium. He's going to pay a premium of $78 for the option to sell his shares for $55 a share, no later than the expiration date of June 19th. Now, we may notice that this actually says 78 cents, not $78. But like we know, one option represents 100 shares, and options are quoted on a per share basis. So 78 cents per share becomes $78. Okay, simple enough. Now you might ask, where do they say it's worth 100 shares? They don't. They probably won't. We just have to know that. One option, 100 shares. Move the decimal point over 2 spots. Okay, the other thing to note here is that if we're going to be buying an option, generally we're going to pay the ask price. That's where we get our premium from. So you scan down those, you'll know how much you have to pay to buy the option. If you were selling it, you'd sell it at the bid price. Just assume you're always going to get the worst price. If you're going to buy it, you're going to have to pay the higher price. Okay, simple enough. Oh yeah, and that's assuming that we place a market order. That's how you end up paying those prices. Okay, now if Jimmy wants the option to sell his shares for $57.50, well, he would pay $134. But let's pretend he decides to go with the next one down the line. He decides that he wants the option to sell his 100 shares for $60 per share. And don't forget, the stock is currently trading at slightly over $60 per share. So technically, this put option is out of the money. You might note the colored area, it's slightly blue. Usually they color the in the money options. In the money defines when the current stock price is below the strike price, whatever that is. That's for put options. If it was a call option, it would be the other way around. Once it gets above the strike price, those become in the money. So for Jimmy, this trade makes sense. He pays $224 today to lock in a potential sell price, the option to sell his shares for $60 per share. So if he's right about Verizon stock, about the fair value, and let's say Verizon stock at the end of this option goes up to $70 or $75 per share, well, he would simply let that option expire worthless. He would lose the $224 that he put up, and then he could decide to sell his shares for $70 or $75, wherever they're trading at that point. Or maybe he decides to hold on to the shares. That's up to him. That's the best part of buying the option, is he has the option. He gets the choice. It is his right to decide what to do with it or not. But what if terrible news comes out over the next few months before the June 19th expiration date, and Verizon stock falls back to $50 per share, which is where Jimmy bought his shares? Or maybe it falls all the way down to $40 per share. Or let's go crazy and say some insane news came out, and for some reason Verizon stock falls all the way down to $10 per share. Well, because Jimmy owns the option, because he bought the put option, he knows that he can always exercise that put option. Which exercise the option means that he will elect to sell his shares for the $60 per share that was in the option that they agreed to. So essentially, this option acted as a hedge for Jimmy. They call this a protective put because it protects our position. It cost Jimmy $224 to buy this put option that essentially acts like an insurance policy for him. Okay, so what about Emily? What does she get out of this? And if Jimmy bought the put option, well, we know that Emily sold the put option. Now let's imagine that Emily sold the very same put option that Jimmy bought, because that will keep the story simple, frankly. But in truth, Emily would have the very same options that Jimmy had. She can choose which time period she wants to sell. Which expiration date does she want to use? Does she want to use an expiration date that's sooner, that in theory would be a less expensive option, or a longer term option that would in theory be more expensive? Either way, she gets the choice of which one she wants to sell and at what strike price she wants to sell it at. But for the simplicity of the story, we're going to say she goes with the same one. Okay, so Jimmy bought the option for $224. Let's imagine that she sold the option for the very same price. So what does Emily stand to gain, and why would she do this particular trade? Well, her potential gain, her biggest upside, her only upside, is the $224. She can't make any more money than that with this particular trade. Jimmy's biggest potential loss when he bought the put option was the $224, and that is Emily's biggest potential gain. So why would she do this, and what is her potential loss? Well, Emily thinks that this stock is going higher, a lot like Jimmy thought. They both believe that the stock should be worth a lot more than it is right now. Well, she's very confident in this particular belief. So by selling the put, she's able to generate $224 in income for her portfolio right now, and she doesn't even need to be owning the underlying shares. And if Verizon stock on June 19th is trading anywhere above $60 per share, well, Emily is going to pocket that $224 because the option will essentially expire worthless. The option will disappear. After that day is over, she gets to keep the $224. And interestingly, she doesn't have to own Verizon shares. So she gets to sort of generate this income without putting up all that much cash. Now, I don't want us to think that Emily could place this trade if she had no money in her account or very little money in her account. Technically, this is a margin trade that she's going to place. So she needs to have enough money or enough capital in her account to cover the margin requirements for this particular trade. I believe to sell a put option, broadly speaking, Emily would need to have at least 20% of the underlying stock's value and a few other things. You have to have how far in the money in it, or how far out of the money is it. You have to have enough to cover the premium that received. In this case, it was $224. So she would have to have at least something in her account. But her advantage is it's not like her collateral needs to be cash. Let's imagine that she has a portfolio of other stocks or ETFs, or maybe there's a little bit of cash in there. But let's imagine that the total value of her portfolio is $5,000. Well, that would be enough to cover the margin requirements for this particular trade. So if she has a firm belief in Verizon stock, well, perhaps it makes sense to place this type of trade, put the $224 in profit essentially into her account. And if she's right, well, that's a pretty good percentage return for a $5,000 portfolio. But this is a dangerous part to Emily's position. What if Verizon stock falls? Maybe it falls down to $50 per share, or $40 per share, or $10 per share. Well, Emily is on the hook to buy those shares at $60 per share because Jimmy, don't forget, bought the option to sell them at $60. She has to buy them at $60, and then she could, in theory, sell them for $50 or $40 or $10 or wherever the current stock price is. So while, yes, if she's correct and Verizon stock keeps climbing higher, she gets to pocket that $224. But if she's wrong, if it ever goes the other way on her, her potential loss, in theory, is the full $6,000, which is the $60 per share times 100 shares. You'd only lose the $6,000 if Verizon stock went to zero. Sure, that's unlikely, but imagine the Great Recession happened, and it happened fast. Or last December, 2 Decembers ago, happened, and the stock market dropped, 10%, 15%, whatever it was in that month. If that was the month her options expired, she was in trouble fast because she had to cover that. And knowing she only had a $5,000 portfolio, well, she might have to put in more capital just to cover that margin call. So the potential loss is the full $6,000. The potential gain is the $224. So I think that the risk reward there, it's up to each of us. It depends on our level of confidence, our level of experience with this. I personally think if you're going to sell an option, it's better if you pair it with something else, but we'll get into that in future videos, different strategies as to how you can protect yourself a little bit. But I do think it's very important that we understand call options and put options. That's going to be the core of everything in the options world. So if you're not too familiar with call options, I know we just watched a video on put options, not too familiar with call options, that could be a good next video to watch. There's a link right here. There's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. I'll see you in the next video. Thanks.